A stock just jumped over 300% in 18 months, while most retail investors were chasing meme stocks into the ground. Advanced Energy Industries, ticker AEIS, went from $47 to trading near $160, and the institutional money pouring in tells me this might just be the beginning. Stick with me for the next 7 minutes, and I'll show you exactly what's driving this rally, why Wall Street's biggest players are accumulating shares, and the specific price levels that will tell us whether this run continues or crashes back to earth. Let's get into it. First, what does advanced energy actually do? Because if you don't understand the business, you have no business buying the stock. AEIS builds precision power conversion systems. That sounds boring until you realize their technology is inside nearly every semiconductor fabrication plant on the planet. Every time TSMC, Intel, or Samsung fires up a new chip production line, advanced energy equipment is controlling the plasma processes that etch circuits onto silicon wafers. Think about that. They're not competing with NVIDIA. They're selling pickaxes to the gold miners. And right now, the gold rush is just getting started. Here's where it gets interesting. The semiconductor industry is projected to hit $1 trillion by 2030. That's not my number, that's straight from McKinsey. And every single dollar of that growth requires more fabrication capacity, which requires more power systems, which flows directly into AEIS's revenue. But here's the pattern interrupt you need to hear. Most investors are playing this wrong. They're buying NVIDIA at 40 times earnings, hoping AI hype continues. Meanwhile, AEIS trades at roughly 24 times forward earnings with direct exposure to the same megatrend, plus diversification into industrial, medical, and data center markets. The risk-reward profile is completely different. Now let's talk about what triggered this specific move. Q4 2024 earnings came in at $2.08 per share. Analysts expected $1.73. That's a 20% beat, and revenue guidance for 2025 came in above consensus. Management specifically called out strength in semiconductor equipment, their highest margin segment. But earnings don't tell the whole story. Watch this. Institutional ownership in AEIS has climbed to over 94%. BlackRock increased their position by 11% last quarter. Vanguard added shares. The smart money isn't just holding, they're accumulating. And when you see hedge funds and major asset managers all moving in the same direction, that's not coincidence, that's conviction. Now I need to pump the brakes for a second, because I'm not here to sell you a dream. There are real risks you need to understand. First, customer concentration. A significant portion of AEIS revenue comes from a handful of major semiconductor equipment manufacturers. If Applied Materials or Lam Research cuts orders, AEIS feels it immediately. Second, the stock has already made a massive move. Buying after a 300% run means your margin of safety is thin. A broader market correction or semiconductor inventory correction could send shares back to 120 or lower before you can blink. Third, China exposure. Semiconductor equipment is now a geopolitical weapon. Export restrictions could create revenue headaches that are impossible to predict. So what am I watching? Here are the key levels. On the upside, 165 represents the recent high. A clean break above that on strong volume signals continuation toward 185, which is the next major resistance zone from 2021. On the downside, 142 is critical support. That's the 50-day moving average and a previous breakout level. If that breaks, 125 becomes the next floor, and at that point, the momentum thesis is broken. Write those numbers down. They matter more than any analyst price target. Now here's my verdict, and I want you to really hear this. AEIS is not a buy and forget stock. It's a buy and monitor stock. The fundamentals are legitimate. The semiconductor tailwind is real. The institutional backing provides a floor under the share price. But the easy money has been made. If you're entering now, you need a plan. Consider scaling in, maybe 25% of your intended position at current levels, with additional buys only on pullbacks to support. Set alerts at those key levels I mentioned, and for the love of your portfolio, use a stop loss. This isn't about being right, it's about managing risk while positioning for upside. If this analysis helped you see AEIS differently, subscribe, and hit that notification bell. I break down opportunities like this every week. No hype, no pump schemes, just data you can actually use. I'll see you in the next one.